Cryptocurrency markets are navigating a complex landscape in February 2026 as two major forces collide. Digital assets, including XRP and Ethereum, face downward pressure from risk-off sentiment and macroeconomic uncertainty, while simultaneously potential tariff adjustments from the Trump administration could reshape the equation entirely. Understanding how these dynamics interact is critical for investors trying to position themselves appropriately, as conflicting signals create both danger and opportunity in equal measure. XRP is currently trading around 137, down dramatically from its all-time high of 365 reached in July 2025, and representing a 62% decline in just 7 months. Ethereum sits at approximately $1,960, hovering just above year-to-date lows around $1,750 and down over 60% from its peak near $4,150. These aren't minor corrections. These are bear market level drawdowns that have erased trillions in market capitalization and crushed the optimism that characterized late 2024 and early 2025, when institutional adoption narratives drove prices to multi-year highs. The catalyst for recent weakness extends beyond normal crypto volatility. Global trade tensions escalated throughout 2025 as President Trump implemented reciprocal tariffs targeting countries with trade surpluses against the United States. The policy, branded as economic patriotism designed to protect American manufacturing and reduce trade deficits, has instead triggered retaliatory measures, supply chain disruptions, and fears of slowing global economic growth. Financial markets hate uncertainty, and tariff policies create massive uncertainty about future corporate earnings, consumer spending, and central bank policy responses. When Trump announced baseline 10% tariffs on all imports in April 2025, with substantially higher rates targeting specific countries, cryptocurrency markets initially rallied on speculation the policies would drive inflation and weaken the dollar, making Bitcoin and other digital assets attractive as alternative stores of value. That narrative collapsed quickly. Bitcoin plunged from $88,500 to $74,500 within 5 days, a 15% crash. Ethereum and XRP each fell approximately 28% during the same period. The reality that tariffs create economic headwinds and risk-off sentiment overwhelmed the inflation hedge thesis, and crypto traded as the high beta risk asset it actually is, rather than the safe haven some proponents imagined. Throughout 2025, crypto's correlation to technology stocks and broader risk assets remained firmly positive, meaning when equities sold off, digital assets amplified the downside. The S&P 500 suffered its worst quarter since 2022 in Q1 2025, shedding over $5 trillion in market value from February peaks as tariff uncertainty and economic slowdown fears dominated. Crypto markets track that decline in real time, with major tokens including Bitcoin, Ethereum, and XRP all breaking critical support levels and establishing lower highs and lower lows, characteristic of established downtrends. The technical picture for both XRP and Ethereum looks challenging entering mid-February 2026. XRP broke below the psychologically important $2 level in early February and hasn't mounted a sustained recovery. Price action shows repeated failures at resistance around 150 to 160, creating a descending channel pattern that typically resolves with continued downside. The relative strength index sits at 43.82, indicating weak momentum without yet reaching oversold extremes that might signal capitulation and reversal. Volume patterns show declining buyer conviction, suggesting participants are more interested in exiting positions than accumulating aggressively at current levels. Ethereum's chart reveals similar technical weakness. After forming what appeared to be an ascending triangle throughout March 2025, a bullish continuation pattern, the structure failed spectacularly with breakdown below rising trendline support. Price collapsed from the $4,000 range to current levels near $2,000, and attempts to reclaim the $2,200 to $2,500 zone have been rejected repeatedly. The RSI has plunged to levels not seen since April 2024, approaching oversold territory around 30. While oversold readings can precede bounces, they don't guarantee them, especially when broader market conditions remain hostile to risk assets. Now here's where the tariff narrative becomes relevant again, but from a different angle. Reports emerged in early February 2026 that the Trump administration is considering reducing or eliminating certain tariffs, particularly on steel and aluminum imports, in response to persistent inflation concerns and political pressure. Consumer price inflation has moderated from pandemic-era peaks, but remains above the Federal Reserve's 2% target, with January CPI expected to show headline inflation around 2.5% and core inflation at 2.6%. While these readings are significantly improved from 2022's 9% peaks, they're not low enough to justify the aggressive interest rate cuts markets were pricing in for 2026. The tariff reduction speculation matters enormously for cryptocurrency price trajectories because it potentially changes the macroeconomic calculus on multiple dimensions. If Trump does reduce tariffs on key imports, the immediate effect would be disinflationary. Lower tariffs mean lower costs for imported goods, which translates to lower prices for consumers and businesses purchasing those goods. Disinflationary pressure gives the Federal Reserve more room to cut interest rates without reigniting inflation concerns, and lower interest rates are unambiguously positive for risk assets, including crypto. Here's the mechanism. When interest rates are high, capital flows towards safer assets like treasury bonds that offer attractive yields without risk. Money market funds currently yield over 4%, providing competition for speculative investments that offer no cash flow or dividends. As rates decline, those safe alternatives become less attractive, pushing capital toward riskier assets in search of returns. Cryptocurrencies benefit disproportionately from this dynamic because they sit at the extreme end of the risk spectrum. They're pure growth bets with no earnings, no dividends, and no intrinsic value beyond what markets assign them based on adoption expectations and scarcity narratives. The Federal Reserve has maintained its benchmark rate in the 5.25% to 5.50% range throughout 2025 and into early 2026, far above the zero interest rate policy that characterized most of the 2010s and enabled the crypto bull markets of 2017 and 2021. Fed Chair Jerome Powell has repeatedly emphasized the need for sustained evidence that inflation is returning to target before initiating rate cuts, and tariff uncertainty complicated that calculus throughout 2025. If tariffs contributed to inflationary pressure by raising import costs, the Fed had less flexibility to ease policy. If tariffs are now being reduced, that constraint loosens. Market expectations for 2026 rate cuts have fluctuated wildly based on incoming economic data and policy signals. Currently, CME FedWatch tool shows markets pricing approximately 100 to 150 basis points in total rate cuts through year-end 2026, meaning 4 to 6 quarter-point reductions. That pricing assumes inflation continues moderating, unemployment remains controlled, and the economy avoids recession. Tariff reductions would support that benign scenario by removing a source of cost pressure and reducing risks of retaliatory trade wars that could trigger economic contraction. For XRP specifically, tariff adjustments carry additional significance beyond the macro interest rate channel. Ripple's core use case revolves around cross-border payments and international money transfers, markets that suffer directly when global trade tensions escalate and benefit when those tensions ease. When tariffs create friction in international commerce, it reduces the volume of cross-border transactions that need settlement, which theoretically reduces demand for Ripple's on-demand liquidity product that uses XRP as bridge currency. Conversely, when trade flows normalize and expand, the addressable market for Ripple's payment solutions grows. This dynamic hasn't shown up clearly in price action yet because the broader crypto market forces have dominated. XRP's 62% decline from all-time highs mirrors the drawdowns in Ethereum and other major tokens, suggesting investors are treating it primarily as a beta play on crypto market sentiment rather than differentiating based on its unique cross-border payment utility. That could change if tariff reductions materialize and Ripple's institutional partnerships begin converting pilots into production-scale deployments that generate measurable XRP demand through actual transaction volume rather than speculation. Ethereum faces its own set of tariff-related considerations, though less directly than XRP. As the dominant smart contract platform hosting thousands of decentralized applications across DeFi, NFTs, gaming, and tokenization, Ethereum's health depends on developer activity and user adoption of applications built on its blockchain. Economic uncertainty and risk-off sentiment reduce that activity as developers face funding challenges and users reduce speculative behavior. If tariff reductions improve economic confidence and risk appetite, it could reinvigorate the application layer driving Ethereum usage and transaction fee revenue that partially offsets ETH inflation from staking rewards. The technical formation on Ethereum's weekly chart shows potential for what analysts call an inverted head and shoulders pattern, a bullish reversal setup. The left shoulder formed around $2,500 in late 2025, the head bottom near $1,150 in early February 2026, and if price can rally and form a right shoulder around the $2,500 area before breaking decisively above the neckline near $2,800 to $3,000, it would constitute a complete reversal pattern with measured target around $3,500 to $4,000. This is not prediction but pattern identification. The setup exists, but confirmation requires price action that hasn't occurred yet. Several factors beyond tariffs will determine whether that bullish scenario plays out or the bearish trend continues. Institutional ETF flows remain critical. Bitcoin ETF outflows totaling over $4 billion in late 2025 created enormous selling pressure that drove BTC from $100,000 to $60,000 in a matter of weeks. If institutional mandates continue reducing crypto allocations due to risk management requirements or underperformance relative to benchmarks, No amount of tariff reduction will offset that structural selling. Conversely, if flows stabilize or reverse as portfolios rebalance and contrarian allocators see value at depressed prices, it could provide the bid needed to establish a bottom. Regulatory developments also loom large. The crypto industry expected 2026 to bring comprehensive federal legislation clarifying rules around stablecoins, custody, taxation, and securities classification. Progress has been slower than anticipated as political attention focused on immigration, tariffs, and other controversies. If meaningful regulatory clarity emerges in the second half of 2026, it could remove uncertainty premium that keeps institutional capital on the sidelines. XRP specifically benefits from having already achieved regulatory clarity through its SEC settlement, but Ethereum and the broader DeFi ecosystem still operate in gray areas that make compliance departments nervous. The cryptocurrency mining industry faces direct tariff impacts that could affect network security and hash rate distribution. Trump's tariffs included technology products and equipment, raising costs for miners purchasing ASICs and other specialized hardware. If those tariffs are reduced, it lowers operational costs for mining operations, potentially improving profitability and encouraging expansion that strengthens network security. While this primarily affects Bitcoin rather than Ethereum, which transitioned to proof of stake, or XRP, which uses federated consensus, the ripple effects through interconnected crypto markets matter for overall sentiment. Looking at specific price targets for XRP and Ethereum under different tariff and macro scenarios requires distinguishing between possibilities and probabilities. The bullish case for Ethereum reaching $3,000 by year-end 2026 assumes tariff reductions materialize, Federal Reserve cuts rates aggressively, institutional flows return to net positive, DeFi activity rebounds from current depressed levels, and the inverted head and shoulders pattern completes successfully. That's a lot of things that need to go right simultaneously. The probability of all conditions aligning is not particularly high, perhaps 25% to 30% based on historical base rates for similar setups. The bearish case for Ethereum testing the $1,500 to $1,600 range assumes tariff uncertainty persists or economic effects of existing tariffs manifest in recession. Federal Reserve maintains restrictive policy longer than markets expect, institutional outflows continue, and technical support fails at current levels. This scenario might assign 40% to 50% probability, given how frequently bear markets extend beyond initial expectations and how challenging the macro environment remains. The base case middle ground sees Ethereum trading range-bound between $1,800 and $2,500 for much of 2026, grinding sideways as conflicting forces balance out. This gets the remaining probability allocation. For XRP, the bullish scenario targeting recovery to 250 to $3 requires similar conditions as Ethereum's upside case, plus specific catalysts around Ripple's institutional partnerships converting to production deployments, generating real XRP transaction volume. Standard Chartered's $8 year-end target that generated headlines requires extraordinarily optimistic assumptions about ETF inflows, CBDC adoption, and RLUSD stablecoin scaling that seem improbable given current trajectories. More realistic upside might target the $2.00 to $2.50 range, which still represents 45% to 80% gains from current levels around 137. The downside scenario for XRP tests psychological support at 1.0, which would represent complete erasure of 2024 and early 2025 gains. This happens if crypto winter conditions persist, institutional adoption narratives fail to translate to measurable demand, and technical support around $1.30 breaks on high volume. The probability distribution might look like 30% upside to $2 or plus, 40% range bound between $1.20 and $1.70, and 30% downside testing $1.00. These aren't precise mathematical probabilities, but rough estimates based on current conditions and historical patterns. The tariff narrative will continue evolving throughout 2026 as Trump administration weighs trade policy adjustments against political and economic pressures. Expect volatility around tariff announcements, Federal Reserve meetings, and major economic data releases. Cryptocurrency markets will react to each development with characteristic overreaction in both directions, creating trading opportunities for nimble participants and whipsaw pain for those caught on wrong side of momentum. For investors with longer time horizons focused on accumulation rather than trading, the current environment of depressed prices and negative sentiment historically represents better entry opportunities than buying during euphoric rallies when prices are extended. The key insight is that tariff policy matters for crypto not because tariffs directly impact blockchain technology or adoption, but because they influence the macroeconomic conditions that determine capital flows into and out of risk assets. Lower tariffs support disinflationary trends, enabling rate cuts that make speculative assets more attractive. Higher tariffs create inflationary pressure and economic uncertainty that keeps rates elevated and capital cautious. Understanding that causal chain helps investors interpret policy developments and position accordingly rather than reacting emotionally to price fluctuations disconnected from fundamental drivers. This analysis is for informational purposes and reflects market conditions through February 13, 2026. Cryptocurrency markets are extremely volatile and speculative. Always conduct independent research and understand risk tolerance before making investment decisions.